Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, welcome.
Thank you. Great to be back, live from New York City.
It's good to see you. So we've had kind of an interesting series of discussions about rules of thumb for a variety of topics, including withdrawal. And Mr. Bill Bengen joined us a week or two ago to talk about the 4% rule. And we've got a great discussion here teed up with somebody else who's a very important voice in understanding how that may work. Do you want to introduce our guest, Ramsey?
Sure, absolutely. So delighted to be joined today by Michael Finke. He is one of a number of sort of very important voices of what I like to call the academic and sort of pragmatic cabal in retirement research. And we're just delighted to have him. He's the professor of wealth management at the American College of Financial Services, and he is the Frank M. Engel Chair of Economic Security. So, Michael, it's been we should have done this 6 months ago, a year ago. Delighted to have you on. So many things to talk about. Let's get right into it. Would like to first of all find out what you've been focusing on, most recently in your in your travels and your practice.
Well, a couple of topics, Ramsey. So first of all, great to be here. Just as a way of background, this is one of those topics that I've been working on now for over a decade. It's been, I think, now 10 years since Wade Pfau and David Blanchett and I wrote the original article criticizing the 4% rule in a low interest rate environment. And since then, I've done a lot of different studies on understanding what risk means in retirement, helping clarify the idea of taking risk by investing in stocks and bonds, and understanding what happens when things go well and when things don't go not so well. And one of the things that I've been thinking a lot about over the last year or two is this idea of a fixed withdrawal rate and a certain amount of safety. So the whole idea of a Monte Carlo analysis. So if you run one of these Monte Carlo analyses, which, by the way, it's just a randomizer. It has a distribution of returns that you can get on an investment portfolio. You have to plug in your expected returns, your expected standard deviation. It'll spit out an asset return the first year. It'll simulate thousands of retirements. Sometimes people get lucky, sometimes people get unlucky. But I think when you run a Monte Carlo and you just do it at one point in time, it gives you this idea that you're 95% safe or 90% safe. What does that safety mean? It means that you can withdraw a certain amount of money every year from a retirement portfolio. And this is really the idea behind Bill Bengen's work is let's look at historical time periods and let's see how much you could have withdrawn from an investment portfolio of stocks and bonds safely historically. And one of the points that I think is not covered enough is that when you run a Monte Carlo and you're doing a simulation and you're trying to capture what asset returns are probably going to look like in the future, because again, we're in a low interest rate environment, we have very high prices on risky assets like stocks, that's going to adjust our expectations of returns downward. What sort of a risk does that involve? Does that change the mechanics of the 4% rule? But also, what happens when you get unlucky? And to me, that is the one area of retirement income planning that is not discussed enough. So if you get unlucky the first year of retirement, so for example, you experience something like investors experienced in 2008, how much does that affect the safe withdrawal rate? Now, we know that you may have had a 90% chance of success the first year of retirement, but that can go down to a 60% chance of success that you're going to be able to maintain the same lifestyle if you have a 2008 occur. And that gets into this idea of the requirement of spending flexibility if you have no safety net. You have to be able to adjust your spending downward if you want to maintain the same probability of success. And there's no getting around that. People, they just cling to this idea that because you had a 90% chance of success the first year of retirement, you always have a 90% chance of success. but that changes every day. Every day your chance of being able to maintain a given income changes. And whatever asset prices were the first day of retirement, which are very high right now, that's irrelevant a year from now. If you would have just waited a year to retire, and you went from $1 million down to $750,000, all of a sudden your 4% rule would be $30,000 instead of $40,000. And I think it's one of these ideas that people don't give enough thought to, that if you want to maintain the same probability of success, your spending path has to be widely variable. Boy, that was a very long answer to what are you working on right now. But it's one of these things that I feel very passionate about that's not discussed enough, is the requirement of spending variability if you have no safety net, because you have to avoid that worst possible outcome.
So it's interesting. You mentioned controlling expenses. I listened to Susie Orman the other day on one of her hour shows. Interesting. I just really wanted to sort of catch up and hear what she was doing. And Michael, her advice always seems to come back to, lower your costs lower expenses. That is one thing I have in my own control, is managing expenses down as you go into retirement a hard thing to do, or is it easier? Is it natural? Do you have any sense of what that pattern looks like for a typical senior?
Well, this is a great question. So I think at the beginning of retirement, the first step needs to be to look at your expenses and to identify which of those expenses is flexible and which of those expenses is not flexible. Your property tax is clearly inflexible. Your health care is inflexible. Paying for insurance on your car is inflexible. All of these expenses represent about 70% of a retiree's budget. And it does not make sense to fund those expenses using risky assets, because you cannot withstand a drop in value. But you can fund those expenses with safe assets. So things like Social Security or a pension or an annuity or maybe a bond ladder. And here's where it gets interesting, because if you fund it with a bond ladder versus an annuity, we know that you spend less each year, or it requires more money up front. You have to allocate more money up front to fund those basic expenses. Now, the second part of the equation is the flexible expenses. Of those flexible expenses, how willing are you to cut back if markets don't perform well? And a lot of people, they look at their gym membership and they say that, well, that's not that flexible of an expense. My vacations are not that flexible of an expense. My going out to dinner with friends is not that flexible of an expense. Therefore, I'm not willing to adjust my spending significantly if markets don't perform well. Remember, the whole point of taking investment risk is that you're hoping to get a higher return, but you have to accept risk. In retirement, what risk means is the possibility of spending less. So the question you have to ask yourself is, are you willing to accept the possibility of spending less on going out to dinner with friends in order to have, on average, more money to go out to dinner with friends in the future? That's the trade-off all retirees need to accept. And anybody who tries to say that you don't have to make that trade-off does not understand the basic economic concept of risk. Risk is real. If it wasn't real, we wouldn't get rewarded for taking it. But it does mean that we have to be thinking about our spending first when we're developing a retirement income investment plan.
So it's a concept that's very compelling, and there's some interesting in my mind, two ways to look at it. Obviously, there's the expenses that are clearly inflexible, right? So the true fixed costs, and then there are others that aren't flexible, but for personal utility reasons, people want to treat them as inflexible. And what I find that interesting is that that potentially opens up the use case for annuities to a broader socioeconomic audience. So maybe there are wealthier people that ultimately are determined that there is a lifestyle that they want to lead, again, they may be activities that aren't absolutely necessary, but they've decided for sure they want to pursue them. And The question is, should those sort of voluntary I'll call them voluntary inflexible expenses, is there a use case for greater use of annuities for coverage of that part of their income needs as well? I'm not sure if that's part of the conversation, but I've always thought that was another sort of additional use case.
When I interview retirees sometimes, what I hear is they're very proud of the fact that they're not spending that much in retirement. And I say, great, it's great that you're using coupons, you're going out to the 2-for-1 dinners early, you're not taking too many vacations, you're not spending too much money. You must really want to give more money to your kids. And then what I very often hear is, no, well, they have plenty of money. I help them pay for their education. They make more money than I ever did. And then there is this silence, this sort of realization that there's only 2 places your money can go in retirement. You can either give it to other people or you can spend it to live better. Now, spending it to live better can mean spending it on fun stuff. It can mean giving money to a grandkid to help them with something that they want to be able to do. But it's still spending. And, it's the objective, no matter how much money you have, is what plan can I use that will allow me, for the portion of my wealth that I want to devote to my lifestyle, what strategy can I use that's going to allow me to spend the most money every year? And the big barrier is that you don't know how long you're going to live, and you don't know the returns you're going to receive on your investments. Therefore, optimally, you'll cut back. You won't spend as much because you want to avoid the risk of potentially running out. It's like if you're in a circus and they take away the safety net. You're not going to take as many risks because the downside is far worse. But if you can somehow take away the risk of that potential downside from living too long or getting bad investment returns, that frees you up to spend more money, especially when the money can do the most good in terms of your lifestyle in your 60s and 70s, when your physical and cognitive abilities are sharpest, as opposed to, in your 90s when, so how many people do you see that end up in their 90s with more money than they can ever spend? And in essence, what they've done is they've been overly cautious, especially if they don't have a strong motive to give the money to someone else. That they realize at the last minute that they could have lived better, but they didn't because of that potential fear. And annuitization, the whole point of it is let's take away that source of risk to free you up to be able to spend more, especially when you can enjoy the money the most.
So, how many retirement plans, Michael, do you think a retiree actually needs? I mean, back to sort of rules of thumb. Well, meet with Ramsey, your advisor, once a year, once a quarter, review how your portfolio is going. Sounds to me like there may be 3 major. Maybe you're redoing your plan in a significant way. 3 times, 4 times in the course of retirement? Do you have any sense of how this actually works in practice with retirees who say, I will end up with too much money, and my kids don't need it. So why am I pinching pennies here? I want to go on that vacation.
Well, ideally, if technology advances enough, and this may not be something that requires constant meetings because you're going to be given the information you need to guide you towards making the right decisions. Your portfolio is going to be automatically rebalanced. You are going to have that protection. You're going to have an idea, a guideline about how much you can safely spend. And then, part of the value of going to an advisor, obviously, is well beyond the retirement income plan. It is, first of all, deciding how much you want to pass on to others. What is the most efficient way to do that? How much you want to spend? What is the most efficient way to do that? Adjusting along the way, having a voice of comfort so that you don't freak out when markets fall. These are all the things that advisors provide. Tax efficiency, understanding RMDs, all the rest of it. Now, there's a huge amount of value that an advisor provides. But when it comes to the retirement income aspect, ideally, you put it on autopilot. And I think one of the reasons why you want to put it on autopilot is that, especially as you get to your 80s and 90s, your ability to manage an investment portfolio is not the same as it was in your 60s and 70s, and decide how much you can safely withdraw from that investment portfolio. It's good to have professional help to do that. Not everybody has access to that kind of professional help. For them, what I'm hoping is that we eventually get to a point where people, first of all, don't have to worry about running out of money, and second of all, have a clearer idea of how much they can spend every year.
Fascinating. So, one of the other things that you've been talking about recently is Social Security claiming, and you've also been talking about contingent deferred annuities. Why don't we start with Social Security claiming? It's a topic that is, as often as it's discussed, it is not it's not knowledge that is widely as dispersed among consumers as one would hope or imagine. So tell us a little bit about how you approach that discussion and how you help educate consumers and frankly advisors on the importance of this.
First of all, Social Security is an annuity. For anybody who says they hate annuities, well, then you must really hate Social Security. But as it turns out, a lot of people like their Social Security. So the idea of getting an income every month for life is actually not such a bad thing to have in retirement. Essentially, that is what an annuity is. And when you think about it as an annuity, by delaying claiming for a year, what you're doing is you're giving up the amount of money that you could have gotten between, say, 62 and 63, and you're getting a higher income every year in retirement that begins at age 63 and then lasts as long as you're alive. And the way that we calculate the value of that income stream is we estimate what it would cost to buy that income stream in the future in a low interest rate environment that costs a lot. And then we look at the likelihood that you're going to be alive at a given age. And we're especially focused on the kind of people that would listen to this show who actually have made the biggest gains in longevity over the last 20 or 30 years. So men in the top 10th percentile of income have gained 6 years of longevity over the last 25 years or so. That's one of the most interesting phenomenon that's happened in the United States is that especially higher income men and women, but higher income men especially because they're not doing stupid things that they used to do in the 60s and 70s. They're not smoking. They're not, they're taking better care of themselves. They're eating better. They're exercising. For whatever reason, they're living longer. Women as well. So women who earn more money live longer. On average, they've gained about 3 years. And so when we're estimating the value of delayed claiming, we now use these updated mortality tables. And remember, the formula that you use to estimate the benefit from delayed claiming was actually created in the 1980s when people were not living as long and when real interest rates were higher than they are today. So those delayed claiming rules are wrong. It means that the actuarial value from delayed claiming is significant. And a lot of people think they're sticking it to the government by claiming at 62. Well, in fact, it's the exact opposite. The government is sticking it to you if you claim at age 62. The other thing that we've noticed is that the delayed claiming rules are tiered. In other words, the percentage increase in income that you get from delaying between 62 and 63 is 5%, but between 63 and 64, it's 6 2/3% per year, and then between 66 and 67, it goes up to 8% per year. And when you actually back out the benefit, the present value benefit that you get, the biggest benefit you get is from waiting between 67 and 68. Why? Because that's the first year of the 8% bump in income. And that means that, by just waiting between 67 and 68, you have almost the same expected longevity, but your income is so much higher that the present value of that bump is as high as $20,000 for a healthy woman. And it's significant for a healthy man as well. And if you're healthy, every year you delay claiming has a positive net present value. It's as if you're buying an annuity that is priced below market. It is pretty much the best deal that you can get from buying annuitization is from delayed claiming of Social Security. So we recommend to everybody who is healthy that they delay claiming, again, because the rules are meant to be actuarially fair, but in fact they're not, because they're old, they're stale, they're probably going to get changed at some point. But if you can delay claiming now, it's definitely in your best interest. Now, annuities are priced the exact same way, or at least the simple fixed annuity products are priced the same way. It's simply a matter of multiplying the probability that you're going to be alive at a given age by the present value of buying that income in the future. And that's one of the reasons why especially late life annuitization is so cheap. So buying an income late in life is so cheap because when you multiply the present value of the cost of an insurance company guaranteeing an income starting, say, at the age of 85, well, there's a relatively, and certainly not 100% chance that you're going to be alive at the age of 85, and the probability of being alive goes down every year after that. So you can buy a pretty significant income for a relatively modest amount of your savings through some kind of a deferred income annuity. And of course, I'm a huge fan of the qualified longevity annuity contracts, the QLACs, because they take away a lot of that longevity risk for a relatively modest price. And that's what's known as mortality credits. If you tried to do it without an annuity, then you would have to set aside so much money today. Let's say you wanted to make sure that your money lasted to the age of 100, which is realistic. If you are a healthy woman, you still have a 9% chance that you're going to live beyond the age of 100. So let's say you only want a 10% chance of failure. You have to build the bond ladder up to the age of 100. It may be 3 or 4 times as expensive to do that as opposed to buying a late life annuity, in which case you can buy away that risk at a relatively low price. You have more money available to spend early on in retirement. You can live better. You can spend more with less risk. And that's one of the advantages of annuities. It sounds like you're a salesperson. It's like you get something for nothing. But in fact, you do get something for nothing. You can spend more, and you're at less risk of potentially running out when you pool some of your retirement savings with other retirees and have it managed by an insurance company or the federal government in the case of Social Security.
Okay, I'm about to throw a curveball here, which is how much does the math and the risk calculus change based on events over the last couple of years? And I'll throw some provocative statements out. One is, delay Social Security because everybody's living longer. Well, actually, mortality tables reversed last year with COVID. And, your statement, Michael, if you're healthy, well, a lot of people who are sick, or had COVID, looks like they're experiencing some longer-term health problems. So, that's one. Another one is, well, let's, not necessarily yours, but, take money out of the equity market, put it into bonds. Some other, people in the market are saying that. Well, look at the credit risk, Ramsey, from half the world defaulting effectively, right, on some of their bonds. What does that do, Michael, to some of these withdrawal rate assumptions? Diversify your portfolio. Let's, yes, you put money in the U.S., but spread it internationally. And we're starting to see almost a bifurcation of economies. If given what's sort of where we're seeing the world get pushed with this war, and then, the really ugly one that everybody's looking at is inflation. So, Michael, is this just is this the one of those bumps you just described? I'm in retirement, I see a bump, and guess what? You survive it, manage the expenses you can, survive it, or do you see a fundamental shift in how you start to approach long-term planning for the next 10, 15 years?
It's a great point. Like, we retirees did not realize that they were exposed to this risk of a pandemic. A lot of scientists understood that risk was a possibility. They face that in retirement. Now, if they've gotten through it and assuming that the pandemic is on its way out, everybody else now is facing the same expected longevity that they had before COVID. So for them, it didn't really make that much of a difference. Obviously, it has a effect on overall longevity. Unfortunately, some people who had expected to live longer did not. But you're still exposed to that same longevity risk. And your job when you're planning for retirement is to address the risks that you're aware of and do it in an efficient fashion. But there's always going to be risks that you're not aware of. I mean, that's just part of the game that you play in financial markets, and just being a human being. We all face a certain amount of risks that we cannot anticipate. And so maybe part of that risk is the possibility that bond markets crash. Maybe part of that risk is the possibility that equity markets also fall, or that the dollar loses value, or that inflation goes up. Those are all things that we have to face. We are aware of those risks. We try to address them as best we can. But the only way to respond to risks that we're not aware of is to recognize that we can be overconfident about the lifestyle that we expect to lead, and to build a certain amount of slack into that lifestyle to account for the possibility that there may be risks that we don't anticipate. One of those risks that I think David Blanchett and Wade Pfau and I have been thinking about for a long time is the risk of United States equities. And a lot of people almost have a religious belief that United States equities are going to continue to provide 10 to 12% return indefinitely in retirement. And if you can just wait it out, if equities go down in value, then everything's going to be okay in the long run. This fervent belief that we are all entitled to what's known as an equity risk premium, in other words, a higher return from stocks than from bonds, can get people in trouble as well, because there is no guarantee. And especially as expensive as stock prices have been in recent years, historically when stocks are this expensive, they simply don't perform that well over a long-term time horizon. That's a risk we're aware of. And if you're not building that risk into your retirement income plan, the possibility that equities are not going to bail you out, then you may end up in trouble. And let me just give you as an example. If you look at, remember, the 4% rule concept is based on this idea that your spending goes up every year in order to match inflation. Of course, inflation is its own idiosyncratic risk. So you can buy what's known as a Treasury inflation protected security as a way of getting rid of that inflation risk. But if you do that and you follow the 4% rule, then at today's low Treasury inflation protected security rates, you're going to run out of money at about age 87. So you're relying on the stock portion of your portfolio to drag your investment portfolio beyond the age of 87 so that you can continue to spend 4% after inflation every year. But there's no guarantee that it's going to do that. And it could do that on average, but if you get unlucky the first 10 years of retirement, you may not have much of an equity portfolio left. So you're putting a lot of weight on that equity risk premium to provide safety that it simply cannot, by definition, provide, because risk is real. It would not be compensated, again, if it weren't real.
So, first of all, super commentary. I have to say we've had. I'm just going to go back quickly to your comments on Social Security. We've talked about it a lot on this show, but you're the first person to break down the PV benefit sort of in those specific tiers. That is actually very helpful perspective there. So one other area that you've been focusing on is contingent deferred annuities. Want to hear what your thoughts are on those. Do you think that that's something that should be more on offer? Do you think people are ready for them? Do you think that advisors and consumers will understand them?
Well, let's say that you have a client and you're a strong adherent in the 4% rule. And the client comes to you and you tell them that you can withdraw 4% after inflation every year from your investment portfolio, and you're probably going to be okay. And then you say, well, what does probably mean? Well, you've got a 90% chance of success according to a Monte Carlo model that uses historical returns. You say, well, what if returns aren't what they have been historically? What if we get unlucky? What if we end up like Japan? Will you provide a backstop? Will you continue to pay my income if I do what you tell me to do? If I follow the 4% rule and I live to age 90 and all of a sudden I don't have any money left, then will you continue to send me a check? And the advisor will say, no, I'm not going to take that liability. I'm not going to take that risk. And then the client says, well, why not? You just told me that there was no risk to following the 4% rule. Why are you not willing to follow that up with some sort of insurance to protect me so that I can feel comfortable spending my money every year in retirement without the possibility, without thinking in the back of my mind that if I spend too much, I could potentially run out of money? Well, that's what a contingent deferred annuity is. It is portfolio income insurance. It is the backstop. And of course, it's going to cost money because your advisor is not going to give it to you for free. He's not going to say, he or she is not going to say, I will write a check out of my own account if you run out of money, and I will continue to provide that income for you in retirement. Now, sometimes I hear advisors or advising companies say that the insurance expense that people pay to provide that backstop is a fee. Well, it's not a fee, it's insurance. So you're paying for an insurance premium, whether it be for the cost of receiving a guaranteed minimum withdrawal benefit from your investment portfolio, or this new thing, which is a contingent deferred annuity, which is entirely separate from your investment portfolio. So you're managing your investments, but then you have this insurance product that's tacked onto it that you're going to have to pay a fee for. But that fee allows you to spend money from your investment portfolio free from the worry that if markets tank and you live too long, you are not going to be able to maintain your lifestyle. Now, that's something that I think, as someone who comes from the RIA community, I didn't give enough thought to. But if you don't have an answer to that question, if you're not willing to provide the backstop, and if your client wants the backstop, then you have to consider buying portfolio income insurance. Now, it's not cheap, but it's not expensive either. So in the sense that it may not be much more than what you're charging for assets under management fees. The insurance company is willing to take on that risk. What does the insurance company do? Well, they put the money into a general account portfolio and safe investments. They might buy hedging instruments. They might buy instruments that hedge against equity risk or interest rate swaps. But that costs money, and it's going to result in a lower expected wealth over time, just like any insurance product that you buy. If you buy homeowners insurance, you will have less wealth over time because you are paying for that pooling risk, so that if your house burns down, then you're going to get a new home. In the same way, you're pooling risk. It results in less wealth over time, but you're getting rid of the risk of potentially running out. And the advantage of that is that even with a portfolio that includes risky assets that could allow you to spend more. So this is a solution, I think, for the flexible part of your budget, is that, yes, I'm willing to take a certain amount of risk, but with my flexible expenses, I am also not willing to cut back so much that I'm not able to enjoy my retirement. So that insurance product then provides that backstop portfolio income protection. Now, from the perspective of an insurance company, this is actually not an incredibly onerous insurance product to provide. Why? Because it only kicks in if the person lives too long and markets don't cooperate. And if you've hedged this appropriately, if markets have done really badly, then your portfolio that you're using to fund this guarantee is actually doing pretty well. So that's why you can buy it for a relatively modest cost, but the benefit in terms of lifestyle is enormous. I can spend money, even if the markets tank, I can go out to dinner, I can continue to go on vacations because I know that backstop protection exists. And from most of us who are in the RIA world are trained to believe that this is just sort of a scam. But if it is a scam, then are you willing to provide that yourself to a client? Are you willing to provide the backstop if they run out of money? If not, then you have to consider incorporating this kind of portfolio insurance into your retirement income plans.
Yeah, look, I think that's a very strong point, and my view is that financial advisors provide an extraordinarily important service along so many parameters, but they don't necessarily have like that skin in the game. And this is the discussion that that sort of puts that at the forefront. I mean, I imagine it can be an uncomfortable discussion, but I think it, over time, there's the potential for it to lead to better and more complete solutions for consumers.
Yeah, I'd actually be interested to know, like, and Mike, you've probably done this. I mean, that product versus an FIA when I'm taking income out, 15, 20 years from now. I mean, how does it compare in terms of the income you'd be able to show a client?
One of the benefits of this type of a product is that you get to capture more of the equity risk premium if you get it. That's why you invest in risky assets, is so that if stocks do well, then your portfolio value is going to rise, and then your guaranteed income amount can also ratchet up. It allows you to spend more. And that's why you take risk in the first place. Mm-hmm. So that you could potentially, with your flexible expenses, you could potentially live better if stocks do well. With a fixed index annuity, especially at today's low interest rates, the budget for your upside is really not that great. So it's really more of a fixed income like potential for growth. Whereas this gives you more upside potential, whereas the downside actually might be a little bit lower than it would be for a fixed index annuity.
Yeah, well, hey, we're close to the end. I just got to have to ask you this question. You mentioned a number of your colleagues you're working with. Wade, we've had on Dave. We talked to Preston Cherry back. I guess it must have been 4 or 5 months ago. We discovered Texas Tech was like somehow a nexus of people doing really interesting work in this space. Tell us more. I mean, is there something in the water in Texas Tech, Michael, that just makes you want to really make a difference in this planning market?
The credit for Texas Tech goes back to a guy named Bill Gustafson and Vicki Hampton, if you've ever heard those names. So those two recognized the importance of the financial planning profession and providing an education to financial advisors that was high quality. And so back in the 1990s, they put together this team of experts, and they became the place to go if you wanted a high-quality financial planning education. And then in 2006, I came to Texas Tech, and my job was to lead the PhD program in financial planning. And a lot of the people who graduated from that program are now heads of financial planning programs across the United States. So the chair of the program at Georgia is from Texas Tech, Kansas State, Utah Valley. A lot of these smaller programs that really focus on financial planning, they're Texas Tech graduates. And when it comes to annuitization, this I think receptivity to annuitization came from this idea that we're economists. We read the economic research, and for a long time, economists have been talking about this annuity puzzle, this idea that people are not annuitizing as much as they should. And in financial planning practice, there's this historical split between insurance and investments, and there's not a whole lot of cross-pollination. But as economists, our job is to try to tell investment advisors how they can actually be fiduciaries. And exposing your client to an idiosyncratic risk like the risk of unknown longevity is not something a fiduciary should do. It's not in the best interest of a client. So we have to then teach them how to do it appropriately. And that's part of what motivated us to think about what are some of the trade-offs between using, for example, the 4% rule, which exposes the client to that idiosyncratic risk of not knowing how long they're going to live, as opposed to another strategy that incorporates some combination of annuitization that allows people to live better in retirement. And so that's really the genesis of a lot of the research. David Blanchett also got his PhD at Texas Tech, but he was doing research on retirement income planning before he came to Texas Tech. Wade Pfau and I and David had done a lot of research together. And really our main purpose is to get advisors to understand when annuities provide value and why they provide value. Really, how to put together a retirement income plan that does the best job for your client. And then, we have obviously faced a lot of opposition along the way from people who like to believe that annuitization doesn't actually provide value. But the reality is that every economist who studies retirement income planning has been saying for a long time that people just simply don't annuitize as much, and they could be happier in retirement. They could spend more. They could have more welfare if they actually annuitize more of their savings. And we just sort of adopted that as the financial planning researchers.
Fantastic. So I think we're at the top of the hour here. It's been fantastic to have you on, Michael, and we would love to have you back on, or make you a regular, frankly, in the coming months and years.
Well, I love that.
Yeah, absolutely, Michael. So for listeners out there who want to learn more, follow your research, where's the best place to go?
Well, I'm a contributing editor for Think Advisor magazine, so once or twice a month I'll be writing articles for Think Advisor. You can always follow my research on Social Science Research Network. Just search SSRN and my name, and you'll find the articles that I've done recently and all the articles that I've done in the past.
Excellent. All right. Well, listen, thanks so much for your time, Michael Ramsey. Great to see you in Thai. And for those of our listeners, join us again next week for another episode of That Annuity Show.